Let's talk about family trust. And I know some of you might be thinking this is for rich people, offshore accounts, complicated legal stuff that doesn't apply to me. It's not. A family trust is used by regular Canadian families, business owners, dentists, contractors, people who have numbered companies, truck drivers, parents who want to protect their kids. They all use family trusts. And the other thing people get wrong, setting up a family trust does not mean you're giving your assets away. Let me explain. A family trust is basically an arrangement where you hold assets for your family's benefit. But instead of owning things directly in your name, the asset sits inside a structure with some rules. And there are three main parties to that. That's the whole thing. Someone creates the trust, usually a family friend or a relative, not you specifically for tax reasons. They put $1 into it, donate some money or some gold coin or something like that, and it's done. Someone manages it, usually you and your spouse. You are the trustees, you are in control. You make every single decision for that trust and its property. And people benefit from it. Your kids, your grandkids, whoever you name. And here's what most people don't realize. You can be a beneficiary too, you and your spouse together. So you're not giving anything away. You're just holding your assets in a structure where you benefit, your spouse benefits, and your family benefits. You keep control of your assets as a trustee. You keep the benefits as a beneficiary. But the way it's structured changes how CRA treats it, how creditors looks at it, and it changes everything. One thing before we go further, setting up a family trust means nothing if you don't put any assets into it. The document alone is just a piece of paper. The trust has to have something, whether it's shares in your private company, your investments, whatever you're protecting. If you create it and just leave it empty, you're doing nothing with it. So what happens when a trust is actually working? Well, I'll tell you 4 things that a will can never do. First, a family trust can let you split income with your family. Instead of one person taking all the business income and paying taxes at the highest tax rate, the trust can flow income to family members in lower tax brackets. Over a decade, the savings can add up hundreds of thousands of dollars. CRA has tightened up the rules in 2018. There are specific restrictions on who qualifies and when. I have written published papers on those rules presented at Canadian Tax Foundation's National Conference and their Ontario Conference a few years ago. I'm going to do a dedicated video on income splitting on how exactly that works. But for today, what you need to know is income splitting through a family trust works. There are rules that you need to manage, but you need someone who knows them inside out. Second, a family trust can multiply something called your lifetime capital gain exemption. We've covered lifetime capital gain exemption on a couple of podcasts before and a couple of videos before, my solo videos. Every Canadian gets a lifetime capital gain exemption on qualifying small business shares. Without a trust, one person claims it, but with the trust, every single family member that is a beneficiary can claim their own. Multiply that across your family and the tax savings on a single business sale can be enormous. The shares have to qualify, there are some tests, but when the conditions are met, there's nothing else in our tax code come close to it. I'll walk you through the exact math in a separate video. Third, control and protection. Without a trust, your will says split everything equally. Your kids could get a check, full access, but what if one of them is just like immature, is like 22-year-old kid and has never managed any money? What if one of them is going through a divorce? What if one of them has a creditor issue? So once assets are in their name, that's it. Creditors can go after them. A spouse can claim them in a separation or divorce. Your kid can make one bad decision and everything basically is gone. But with the trust, a trustee decides when to distribute, how much, under what conditions. They can have complete discretion also. They can hold it for one kid until they're 30, they're matured, or distribute to another who needs the money. You can even add your own grandchildren later. Because the assets are in the trust and not in your kid's name directly, they're harder for creditors to reach, harder for a spouse in a dispute to reach. I've seen this play out in my experience. A professional got sued, lost the case. The only asset the other side couldn't touch were inside his family trust. Everything in his name was exposed, and that protection does not exist in any will. Fourth, and this is the one that surprises most people. Remember the stroke scenario? Your mom is incapacitated, can't make decisions, family scrambling for legal authority. Well, here's how a family trust changes that. If a trust already exists and the assets are already inside it, your co-trustee or your successor replacement trustee steps in immediately. No court, no petition, no months of waiting. The structure is already there and working. Bills get paid, investments get managed, decisions get made without any legal battle during the worst time in your family's life. If you recover, you take back the control of your trust. For a lot of families, especially families with aging parents, this is the strongest reason to have a trust. Not the tax savings, the peace of mind that someone can act immediately when it matters the most. When you stack all four of these things together, the income splitting, lifetime capital gain exemption, multiplication, control, incapacity planning, the difference between family with a trust and a family without one is staggering. I have seen it firsthand. Same assets, same CRA rules. One family planned, one didn't. The gap is hundreds of thousands of dollars and sometimes well beyond that. Sometimes it is peace of mind.